Welcome to the Cutting the Gordian Knot podcast. Today, we have a cage match, an economic cage match, so don't get too excited. It's between fiat currency and fractional reserve banking versus Bitcoin in the other corner. And we'll be going through how fractional reserve lending works, what fiat currency is, how our system works, how it developed from a gold system. We'll be hitting pros and cons, and questions and objections, and what's up with inflation and deflation. And finally, we'll kind of round it out by addressing Bitcoin and finding out, is it better than fiat? What's wrong with Bitcoin? Why don't we just all use that? But I want to start with a bit of a story. It's probably one you've heard before, and it's true, but we really got to be very careful about the ending and the conclusions that we draw from the ending. It goes something like this. I'll tell it fast. We began with bartering. Maybe I have a goat and you have some eggs. So how are we going to trade? Well, I can't break off a piece of the goat, so that's kind of tough. I might not necessarily want eggs. I might want to get eggs to give to somebody else to get something else. So there's multi-way trades, there's divisibility issues, there's transport issues. Lots of things are problematic with barter. So soon we come to something that we just all like, and we use this to clear transactions, and that's great. And commodity money like silver and gold really rose to the top, and gold became really the thing. It's got a lot of great qualities, yay gold. It's divisible, fairly verifiable. It's a lot of value in one small package. It doesn't increase in quantity to a crazy amount. It's fairly regularly mined. It's got a lot of perks. We like gold, sure. But then here's the twist. People realize they don't want to hold a bunch of gold. It's a security problem. They might not want to carry it. They could get mugged. This is an issue. So how do we solve it? Well, what if we just brought it to the goldsmiths and had them lock it up in their safes? They have security. Everything's great. And then they can just write us a certificate of deposit. And we could use this as our money, at which point, bang, we have paper money. Now, guys, that is not the whole history of money. That's not how it always worked. There's a lot more complication there. We had the Spartans using iron coins just by dint of law. We had the Song Dynasty using paper money, at times backed, at times not. We had fractional reserve lending at other times in history. We have a lot of complication, but you've probably heard that basic story. Now, the twist is, what happens with these goldsmiths? What do they do? Now, you may have heard the story told like this. They realize, hey, I got 100 pounds of gold and nobody knows. Why don't I just write up a few more certificates than actually is represented in my vault? Ha! And this is fraudulent, and this is bad. And in this scenario, if this is all that happened with the balance sheet, they would be, if we address them as a bank, an insolvent bank. Because those deposits for the consumers, those notes they wrote up, those represent a claim on the goldsmith. And their assets to meet those claims are not sufficient if they only have 100 pounds of gold to meet the obligation of 200 pounds worth of gold notes. They're an insolvent bank, and this would be fraudulent. And maybe they're using this as their own currency. Maybe they're giving this to their friend. I don't know what's happening, but if this is the entire story, it's very problematic. Now, some people think this is the whole story. Nothing else was necessarily going on. This is the whole balance sheet thing. 200 of liabilities, 100 of assets, and a problem. And then they extend this to, and that's how we got the current system. It's also fraudulent. It's also in principle insolvent. It's on such a shaky foundation, we should never have it. We just need to go back to sound money in the form of a full reserve gold system. Or in the present age, people say, well, we have a digital gold like Bitcoin, and we could just use Bitcoin. And there's going to be no funny business around this, and that's clearly better. The reason why I want to zero in on this story is because it's the basis of so many arguments. And I want to correct it subtly. Not everybody gets this wrong, but I think a lot of people get it wrong. What could instead happen with a perfectly reasonable, non-fraudulent fractional reserve system is that what they back that 200 in deposits with is not just gold, but is also another asset, which also has value, and that would be a loan. Because here's how fractional reserve banks work. They create a deposit and a loan at the same time. And when they do that, the customer, let's say it's a farmer who wants to develop a new portion of his land into a productive field, that would be a great reason to take a loan. He doesn't have the cash to do it now, but he's bringing something of value into existence, which will then yield a return. This is like peak banking here. This is what we want. Now he comes to the bank, and the bank writes up a loan for $10,000 and says, you owe us 10,000, but we just put 10,000 into your account. So now, from the farmer's perspective, he has a new liability, a $10,000 loan. But he has a new asset. He has $10,000 in the bank, which is a claim on the bank. From the bank's perspective, they have a new asset, a $10,000 loan that the farmer has to repay. But they also have a new liability, $10,000, which they agreed to pay to the farmer at any time he comes to collect it. So we see the books are balanced on both sides. So now he repays the loan with some interest. The bank makes money. That increases their bank capital. So now the bank has a little bit more cash, but he created value in the economy. And the upside is because we increase the total amount of goods and services in this example, by bringing this new productive field and bringing new, vegetables into the world, we also were able to, at the same time, expand the money supply. So there's money in the economy to fund these additional transactions. And in this case, that's not inflationary, because inflation is too much money chasing too few goods. But here, with fractional reserve lending, as the goods are coming into existence, the money comes into existence too. And this means that the real economy, real economic growth, is never just artificially constrained or constricted because of a lack of cash to clear transactions. And it's not distorted by creating like deflation as we have a bunch of productive assets coming in. And then we'll get to inflation and the problems thereof. So with a good, properly functioning fractional reserve lending system, this can be wonderful for economic growth. And we see that there's actually, we'll hit some questions and objections there, and we'll get some more clarity. That's all I want to leave you with there, is that we have a loan and we have a deposit coming into existence at the same time. And it's not that we have 200 in deposits and only 100 in assets. The loan is an asset. So now those deposits are backed by two things: gold and the asset, which is the loan. Now, the cool thing is, through most of this history, we can just always take the deposits, that money that's issued by the bank, and redeem it for gold. So what happens if all sorts of people want to come and take their gold out? Well, the bank doesn't just collapse. It would simply sell that valuable loan that the farmer took out to maybe another bank. Somebody else could call it in. Who knows? At which point, they could simply use the cash that they generated from selling that loan to go and buy gold somewhere else and give it to the depositors. No problem. And there's a cushion built in to make sure the depositors are okay, and that's called the bank capital. And today we have a lot of regulations to make sure that the owners of the bank have real skin in the game, okay? So that the owners of the bank take the first loss if there's a mismatch between the value of the deposits that it's promised to pay to others and the value of the assets on the books. Okay, so there's a cushion there. And sometimes it's mandated to be, say, 10, 20%. It depends on the regulatory environment. So let's deal with a few common questions and objections. First is, well, hang on, if banks can just magically create this, what stops them from just making an infinite amount? And there's a few things. One, there's only so many creditworthy borrowers and good uses for this, because if they don't get paid back, this causes their bank to be insolvent. So they are careful about this. Next, in, say, a fractional reserve lending system, if they just go bananas and they issue way too much currency and it's not representative of the assets that they have in the book, which actually have market value, then their money, you might as well just hold gold at that point. So people will take the money and say, you know what, I think you're kind of getting a little out of control. I don't want to hold these notes because I don't trust them. Convert them into gold. So that's a check against the banks going crazy. In today's system, we're not backed by gold, but, and we'll get to this later, instead you can simply redeem it for base money, which would be, say, cash, or in some cases, central bank reserves. You're probably not redeeming it for that, but you could just ask your bank, hey, I think you're a little bit risky here. I don't trust your asset management, and maybe I have more cash at your bank than is covered by the FDIC insurance, so just give me the cash, thank you. And that's always an option, and that's a check. They also commonly just have capital requirements, so they can't always expand their balance sheets infinitely because they're required to have a certain size buffer. So they need to build up that buffer by doing profitable lending so that they could then expand the balance sheet. And finally, there's just plain old competition from other banks who also want to get good qualified people to lend to so that they can make some money too. The other thing is, well, are they just creating money from nothing? I think that's a misleading statement. I could see why somebody might say that. However, what they're doing instead is they're expanding the money supply by making a debt on the other side of the balance sheet. So I hope that makes sense. I don't think it's creating money from nothing. It's allowing us to essentially use debt financing here in order to fund having currency. Now, another thing you probably heard is, well, what does fiat mean? It means like, let it be done. It's just like a declaration. It is. It's just that. So it's not actually backed by anything. Not really. It is backed by something. And I think if you listen to what I explained so far, you could probably guess what it's backed by. Remember, we kind of had that stage 1 story where just gold is money. Then we have stage 2, where we have the fractional reserve gold system, where gold and that bank credit is money, but the credit can be redeemed for gold. And now we're kind of the third rev of this whole shebang, where credit and base money are both money, and credit can be redeemed for base money, like cash. So, is it backed by nothing? No. You have your money, and that's a claim in the bank. And the bank has a claim on a portfolio of loans, and it has the owner capital. And those loans are a claim on either an asset, like a field, or a house, or a car, or they're a claim on an income stream, which has value, right? So ultimately, it's backed by what was the basis of the lending to begin with. So it is backed. We should probably do a bit of a distinction between base money and broad money. So we have two types of money, guys. You probably have base money in your pocket right now. That would be cash. And it's also the reserves that commercial banks hold at the central bank. That's base money. And that's what's created by the central bank. And then the lending, which I described, is just like the credit which is being extended, and it's the money that's being made by private banks. So when you hear, oh, the government caused inflation, or the government is increasing the amount of money, that's kind of true because the government has a lot to do with it. We won't be able to get into everything. However, at its core, the majority of money creation is done privately. And that's in the form of just expanding credit, like we were describing. Though the central bank can also do that by, say, quantitative easing and other means. Now, the number I've seen for like what percentage of money is broad versus narrow is typically 80, maybe 70% is broad money, and then the rest of it would be base money. Now, after we had, say, the Dodd-Frank regulations, that meant that the central bank was doing a lot more of the money creation, and I would prefer the majority of money creation to come privately from the banks looking for opportunities for good return at a micro level and making wise and prudent decisions on where and when to extend credit and thereby increase the quantity of money in the system. That's what I would like. All right, so yeah, we got to get to what about the Fed? So I think you probably have an idea of how your money is backed if it's that type of more broad money, like what you have in your bank account. But what about base money? What is your cash backed up by? Well, your cash or those central bank deposits, which are in the which say a commercial bank would hold, so they have money that's a deposit in the central bank. These are claims on the Federal Reserve. Okay, what's that backed by? Well, these would be backed by like treasury bonds, which it holds, or it could be loans even to the commercial bank, or it could be mortgage backed securities, or occasionally it buys other assets too. Probably shouldn't, but it does. So you have a claim on that. Now let's take treasuries, for instance. What are treasuries backed by? Well, they're backed by the fact that it's a claim on an income stream, and that is the largest income stream on earth, the taxes which come from the American economy. So that's what it's ultimately backed by. Um, I would add a few other things here, and we'll get to more of this as we contrast it with Bitcoin. But you know that there's going to be a price for the dollar because it's demanded that you pay this in taxes, which is the classic way to get broad acceptance of a currency. You simply say, all right, use whatever you want, but when tax day comes around, you got to use this. So it becomes universal for that purpose. We also, well, we'll get to the rest later. So there you go, guys. That's how I would answer the idea that, well, it's not backed by anything. I think you guys probably have the idea of how broad and base money is backed and what it ultimately terminates in. Now, you might say, listen, I just don't like centralization in a central bank like the Federal Reserve, and that's why I would want Bitcoin, or heck, just a full reserve gold standard and just throw it all away. Listen, I get that. I'm not the biggest fan of the Fed. I happen to believe they're pretty darn good at their job compared to other central banks, and we have a little bit to be proud of here. The way they handled COVID versus the way other banks handled COVID. I got to give them some amount of props. Yeah, we can all nitpick, but at the end of the day, we had some of the lowest inflation, the lowest unemployment rate, and the highest growth rates coming out of that. And yeah, they made some decisions that we weren't all fans of, but they were trade offs, like allowing inflation to rise. That meant that we didn't get crazy amounts of unemployment. And you'll probably learn about how that works when we get to the deflation part a little bit later. But we don't have to say, well, fiat just comes with a central bank. It doesn't have to. There's free bank proposals. And it also doesn't mean that, well, fiat currency means there's no role at all for a gold. We could have a fractional reserve gold-based thing, which is paper money. Yeah, it's that kind of credit. And it's kind of like an in-between. It's not like a full fiat currency that we have right now, which is based in these in this base money from the Federal Reserve, but it's kind of an in-between system. And I like that. And that's pretty cool, like what Dr. Lawrence White lays out. I really like his system. And you can go back to hear the interview that I had with him. And another good interview to listen to is the one that I had with E.J. Anthony. I think it's also Dr. E.J. Anthony. Both of those interviews I think were really good. So if you want to learn a little bit more about the whole banking stuff and comparing this, I would go to those episodes. And Dr. Lawrence White has a book out, which is Gold, Bitcoin, and Fiat Currency. And he contrasts that in a really clear way. And I would highly suggest it. I read it. I liked it. I forgot it. But I'm sure some of these ideas are somehow floating around my head because of that book. So read it, guys, if you want a much bigger treatment. We're rolling through this pretty darn fast. But I will say, the idea that you don't like a central bank, therefore just ditch fiat currency, no, that they don't necessarily have to be paired. You could have free banking, and I think free banking's cool. And you can look into that one. It was present in Scotland for a long time, and it's pretty neat. All right. Another common thing I hear, kind of as an objection to this, is, well, look at the graphs that as soon as we dropped like the gold standard, we had wages suppressed, and wages didn't keep up with productivity, like forever after, or they didn't keep up with overall economic growth, or whatever your metric is. So therefore, our money is broken. Ergo, we need to go to digital gold, Bitcoin, or actual gold, or something else. But fiat currency has failed us because we ended Bretton Woods. We completely disconnected from gold. Now we're just full fiat over here. And look what happened to the regular worker. You want that? No, your money system's broken. Well, look closer, my friend, because the divergence didn't actually line up with what you think it lined up with. It was close, don't get me wrong, and if you don't zoom out on the graph, I could see why you would think that. There was something else which has lowered worker wages for like a couple decades, which was a much bigger effect and actually lines up time-wise with the data pretty much perfectly. And that is the dawn of contraception. And at this point, women started flooding into the workforce. And I'm not going to make an episode about, the morality or what's good or bad about that or the situation. All I want to say is just imagine if tomorrow half of the population all of a sudden said, I'm not working and I think I want a job. I'm going to go out looking for a job. Do you think that's a supply shock? Oh, that's a supply shock to end all supply shocks right there. So as we increase the supply of something, the price is going to go down. Now, luckily, we had such a productivity increase and we had enough economic growth that we didn't see like an absolute drop in wages. And it's not that all women came to get a job at the same time. They kind of began to get into the workforce at an increasing rate. So what happened was we just didn't have the wage growth that we would have expected. And it's because of a prolonged supply shock whereby more and more workers were flooding in. That's the main reason. It's not a fiat currency thing. Another thing that happened is we said that employers have to pay for healthcare insurance for full-time workers. And even before that, it was fairly common to have employers do that. So oftentimes these graphs are looking at take-home wages. And the take-home wages are going to look pretty darn stagnant when your employer, well, he just had to pay way more for your health insurance. So if we have healthcare inflation at 9% a year, it becomes a larger and larger amount of your total compensation package. And that's going to eat into what would have been your wages. And you just never see it. And we've done episodes on healthcare and all the stuff that I would have done to that. And many ways to fix it. Look back and check that. But these are the two replies that I would have to the common charge that when we broke from the gold standard, everything just got worse. There were more things going on, and it wasn't just a defeat of fiat. The next thing I want to address is, but the Federal Reserve, it's this shady organization, and there's lots of conspiracies around it. Like, aren't the conspiracies true? Isn't it the Jews who are collecting all the interest, or the Illuminati, or whoever? Listen, guys, I'm all for auditing the Fed. Sounds great. I'm all for essentially shutting it down and just having them operate with, say, nominal GDP targeting, or a Taylor rule, or adopting a different system. Just having Dr. Lawrence White have a field day and figuring it out for us. I like the guy. He's got great ideas. I'm all for that, okay? I'd probably prefer a system without the Fed. I think we could use a clearinghouse, other ways to do it. But here's the thing. I don't think they're cooking the books. We have this public. There's a variety of banks which make up the Fed, so it'd be a heck of a conspiracy. Also, there's banks which help to capitalize the Fed, and those would be the commercial banks. So if they're really cooking the books, the commercial banks would be very upset about that. And they do have some amount of oversight. And also, like, I've had people who worked at the Fed here on the show. Like, I've talked to such people. It's not a giant conspiracy. We know basically what's going on. An audit could uncover some things, and I'm not opposed to it. Transparency is good, but I just don't think that we should think this is a conspiracy. And a lot of the root of it is people say, well, who's even getting the interest from the Federal Reserve stuff that they own? They own all this debt from the US and they're collecting interest. Where does it even go? Well, I'll tell you where it goes. So whatever money that the Federal Reserve makes, the first amount just goes to cover all of like their administrative expenses, pay salaries, all that stuff. The next part goes as a mandatory dividend, and this dividend is paid to the banks which helped to capitalize it. Recall that like bank capital, so that ownership capital, which is the buffer against loss. So to the extent that commercial banks capitalized it, they're paid the lesser of 6% or the yield on the 10-year treasury. That's reasonable because they gave up some money, so that would be their capital stock. Great. Not even a crazy return there, but they get something for that, and that's reasonable, I think. And what happens to the rest, though? Well, the rest of it, is turned over to the Treasury because this is not a for-profit bank. So all of the money that the Federal Reserve makes past making the ownership capital guys whole and administrative expense just goes to make it so we don't pay as many taxes, make it so we don't run as big of a deficit. It's just turned over to the Treasury because they're not a for-profit bank. They're kind of a pseudo-private bank. Kind of private, kind of not. We want them disconnected from politicians, but we don't want them just earning fat checks off of the US government. And they don't. So let's get to some advantages of fiat and fractional reserve. We kind of talked about one, and that is we have as they issue loans, it creates money, and that means that it provides the cash that the real economy needs as it is expanding. Done right, and especially done at like a really granular local level by banks which have on the ground knowledge of what's going on in the economy locally, this can be a recipe for absolutely explosive economic growth. And that's an enormous advantage. Now, there's also downsides, right? And we'll get to some of those. But here's the downside of commodity-based money: is commodities do move in value, but if you fix it, then what moves in value instead are the prices which are denominated by it. So although in the classical gold standard, for example, we averaged zero inflation, we had a lot of volatility along the way, including some periods of deflation. So if we use something like, say, Bitcoin, and we just fixed the value of it and we used it kind of like we used gold at some times, then we could see a variation in prices, which even if long term they averaged zero or more likely declined because gold does increase in supply, whereas Bitcoin eventually becomes essentially no increase, then yeah, we'd have those periods of volatility. There you go, words. Also, fiat currency has the advantage of being way cheaper to run than something where it's like a full reserve gold. Probably way cheaper to run than a Bitcoin system because the bank can simply make a loan and make some dollars. Cool. And then everything is just an entry on bank sheets and the world goes round and round. And a fractional reserve gold system can take a tiny amount of gold and make it back a huge amount of things because we can always just sell another type of asset and purchase the gold and refund the few people who want to hold gold in particular. So, I mean, Dr. Lawrence White points out that we could have a fractional reserve gold system, and the cost of obtaining the additional gold each year in order to run this system and basically delete the Fed turns out to be a little cheaper than the budget of the Fed. So we can economize on this if we use fractional reserve. And if we just don't have it at all, well, we could certainly trim the Fed and save some money there. But long story short, compared to having like a warehousing full reserve model, it's a lot cheaper. And finally, it's really easy to avoid deflationary events with fiat currency. We'll talk a lot about inflation and deflation shortly. So let's get some disadvantages of fiat currency, because so far, hey, it sounds like I'm quite the wild advocate. Well, here's some bad things that can happen. Those banks can have the assets on their books lose value. Let's say in 2008, we have housing drops, which means the collateral backing those mortgages fall. We had a shock to the economy such that people can't repay their mortgages. So the mortgages are now worth less. And then sometimes the bank capital wasn't enough to make up those losses. So there was still a difference. And that's when they did QE and tried to save banks and made sure that the depositors were indeed made whole. But that's a problem. We've tried to mitigate this with FDIC insurance so we don't get flight out of these banks with people with less than 250,000 because it's insured. Everything will be okay. So that can prevent bank runs. We also have the lender of last resort function where the Federal Reserve can jump in and make sure that there's that we lend to the banks to make sure that they have the cash to pay all the depositors or to get through a difficult liquidity event. And then we have other banks who may have been more prudent, cough, cough, JP Morgan Chase, that can simply purchase those failing banks for pennies on the dollar, acquire their assets, some of which, if held to maturity, will make them whole. And there you go. Problem is we get bank consolidation, but that is a bit of a solution in many times of crisis. But still, we can have what is backing those deposits lose value. It's a risk. And there's ways to deal with that. We could also simply increase the capital requirements. So instead of having a safety buffer of nothing or 10%, we could have it of 25% and then be really, really sure we're not going to hit a point where that gets wiped out too. Here's another one. This one's kind of controversial, and I need a certain economist to come and chat with me on it. And you can kind of hear the discussion that I had with E.J. Antony on this. I think that there's times where there's good loans and good money coming into existence, and there's times where this makes a boom-bust cycle. So I gave the example of the farmer who's doing something productive. A new good or service, something valuable is coming into existence. Great, bring some money into existence at the same time. But that's not what all loans go to. Sometimes they are borrowing consumption from the future, or they're bidding up assets, which can create a bubble. So if you're just buying existing assets and you're taking loans on that, that can cause it to be bid up and up and up and could be what could cause a crash. And likewise, if you're just borrowing consumption for tomorrow, when tomorrow comes, well, overall consumption, overall demand will fall. And that means that we could get a boom-bust cycle where things look great now, lots of demand, and everything ramps up to supply, and then it comes in later, and we just kind of get the hangover from that money that we were playing with today. So in those cases, it can create boom-bust cycles, and that could be more regulated under other systems. Maybe not Bitcoin, but in other systems. Now, what do we do as a solution? One option is, well, maybe we just need higher interest rates so that people are less likely to just use it to bid up bubbles and less likely to borrow consumption. And instead, we have a higher hurdle rate, which clears a lot more things like productive investment, which will indeed create the cash flow to pay for the interest. Maybe that's part of the answer. Maybe we need differential capital requirements, where if a bank is lending for a productive asset, I don't know, hold 5%. That's all the bank capital you need to cushion that. But if this is something just for consumption, you're going to need 25%. And maybe assets are somewhere in the middle, or heck, even higher. I'm not sure. Now, are there ways that we can kind of engineer this, create good rules, or come up with market mechanisms? Maybe. Or maybe, as EJ said, these loans are just fungible and it's a fool's errand. I don't know. It's when we get to this issue, my current economic kung fu is not formidable enough to tackle that problem. So I'm going to need help on that one. And I think I know the economist for the job. But you'll have to wait for another episode and hope he says yes to an interview. Now, the other disadvantage is this can encourage governments to monetize their debt, right? Because we have the Fed who purchases treasury bonds, and then the cash becomes a liability, and then the treasury bond becomes an asset on their books. And then for the government, they gave up an asset in the form of the treasury bond, right? Because they sold that one off to the Fed, and then they get an asset in the form of the cash. So now they're basically getting to just monetize their debt here. And that can mean we get less fiscal discipline. And I like fiscal discipline. So this is certainly a disadvantage. When governments can monetize their debt, they commonly do. That can mean inflation. And that's what we need to talk about next. So let's talk inflation and deflation. Let's start with inflation. We all lived through it. And it wasn't that fun, right? We see the prices of things are higher. Nobody likes that. And it's particularly bad when it's unexpected. We weren't able to brace for it. And we have to just kind of hit a new equilibrium with things like labor prices. Now, Bitcoin claims to be a hedge against inflation. I mean, gold did pretty good in the classical gold standard days, where we averaged around 0% inflation in the pre-Bretton Woods system. And we'd probably get deflation if we used Bitcoin because we just fixed the amount of total Bitcoin. And deflation is great, right? Because we don't like inflation, so we must love deflation. Not so fast. First, I want to reframe inflation. There are three ways that the government can deal with its crushing debt load, which is here whether you like it or not. Shouldn't be here. Should have been smarter. We weren't. It's here. Three ways to deal with it. One, we can increase our taxes. Now, our tax system isn't ideal. I'm working on it, guys. You can go back to the fair tax episode. But the tax system means that some people are taxed, some people aren't. A lot of productive activity is hampered through things like capital gains taxes, corporate income taxes. Also, people dodge taxes, people cheat on taxes, so it's not always entirely fair. There's lots of loopholes to taxes which shouldn't necessarily exist. So we could just increase taxes. It would certainly slow down our economy. It wouldn't be entirely fair the way the system is today, and that's one option. And guess what, guys? Economics is not about solutions, it's about trade-offs. And sometimes we can make a package of trade-offs which is better overall, but there's still trade-offs in that pack. The next option is we say, let's do austerity. You know what? Just do a haircut for the Social Security checks, Medicare, Medicaid. Listen, I know people are sick. We're not going to be able to pay everything. You're just going to have to deal with the medical debt. Defense, we're going to have to trim it. We can't project power like we used to. And yeah, enemies might fill the vacuum. Maybe we need to trim a bunch of other government services, but really those are the big ones, guys. Social Security, Medicare, Medicaid, and defense. That's by far and away the majority of the budget. So what do you want to cut? I'm going to have to cut it aggressively, and it's not going to be all that fun. And it's politically impossible to do that. You're not going to cut the check to grandma for Social Security. But there's one more, and that's inflation. That, yeah, they have the power to inflate. And what happens? Well, it's essentially a super broad-based tax on everybody. You all paid it, guys. Wasn't fun. Does it hurt the economy? Yeah, it does. So do taxes. Austerity does, at least short term. We do need to get spending under control. Maybe that's my favorite of these. But you can understand why people say, all right, let's just all have the pain all together. And if we increase the money supply by 30%, 50%, that debt is way more manageable now because we pay it back with inflated dollars. Now, again, this has trade-offs, right? It means that maybe in the future, people expect that we're going to do this again and have another inflationary event, which means our long-term borrowing costs could increase. Yeah, that could happen. It's really not fair to our creditors to pay them back in inflated dollars, but they knew this was a real risk that could happen, and they lent. And these are sophisticated people, so, I mean, there's an argument. But I do just want to frame it as it's not just, well, they just stole the value of my dollar. Well, they could also steal the value of your Social Security check. They could also steal the value of your wages through taxation. And the fact is, we just need to think of this probably as just a tool of public policy. And as it goes, I don't know, maybe sometimes that's the right tool. The next is the Phillips curve is wrong, but not in the short term. What's that mean? Well, the Phillips curve says that there's a trade-off between employment and the inflation rate. Long term, no, there's not. It doesn't work like that. But in the short term, it can have this effect. So after COVID, we pretty much beat everybody as far as we had some of the lowest inflation, we had some of the best employment stats, and we had some of the strongest economic growth coming out, or the strongest for each. I mean, we did really well overall. Now, inflation, when we ran it hot, we likely saved some jobs. So let's kind of talk about how that works. No, we're going to have to get to the deflation part. Sorry, guys. That one's really we get a cliffhanger here. So what's wrong with deflation? I think we kind of talked about inflation here a little bit. What's wrong with deflation? I mean, it sounds great, right? Falling prices? Well, it's not just falling prices for the stuff you want to buy. Would that it be so? That would just be like productivity, as if everything stayed the same and prices fell. Love it. No, deflation is when everything falls, which means, great, the watermelon you wanted to buy is $4 instead of $5. But guess what? Your wages fell too. And did you own a house? Oh, that fell too. Your house will continue to fall in value, not appreciate. Oh, you have a car? You got a tractor? You got anything? Do you own anything? All right, that's all falling in value too. and your wages will be less next year and less the year after that. And in the short term, when we get inflation over the short term, this can cause like a starvation of firms. Now, here's a flawed analogy. Let's say we say eating makes you healthy. Might go, wow, well, let's just like eat a ton. Well, if you eat a ton, you're going to get fat and inefficient and slow. But if you take too long of a break from eating, well, you can starve and die. That's kind of what it works with spending and aggregate demand in the economy. If you have too much aggregate demand, like if you boost it artificially, you're going to get a fat, inefficient economy, like you ate too much food. However, if you just stop it all of a sudden, then you can get starvation. For example, you're a business and all of a sudden we get deflation like crazy. Deflation is just happening all of a sudden. We weren't prepared for it at all. Deflationary event. And there's ways that this happens. And it creates a spiral. And we'll get to the spiral. Long episode, folks. In this case, people could hold back spending because they think, well, I'll just buy stuff later. At which point, yeah, eventually they'll spend. They will. But how long can a small business stay with that lower revenue? I don't know. When are they going to have to just close up shop? When are they going to have to start firing people? And now we get less demand in the economy. I don't know. When you stop demand for a bit, it can cause real economic harm. It can take firms that were economically viable and make them no longer economically viable, even if the tides change later. So deflation over the short term can cause these types of problems. If it's like a persistent thing, then people have no reason to indefinitely delay stuff, and we could have more savings and stuff like that happens. But there is a short-term kind of shock that is challenging to deal with. The next thing is wages are sticky. So people don't like their wages cut. It's very difficult psychologically, practically with certain contracts to just say, hey guys, there's deflation, so we're going to pay you less next year. What? People don't like that. So what can happen is that firms which would have been viable will become no longer viable because their revenues are falling. There's less dollars coming in because of this deflation. And now their labor cost is static. So now what are they going to do? They're going to have to trim. They're going to have to trim somewhere. They're probably going to fire people. That's what's going to happen. So oftentimes when we get deflation, because wages are sticky, we don't just get a smooth change in wages. We get a jump in unemployment. And that's what I was talking about with the Phillips curve, that it can work in the short term, right? Because there is a trade-off between inflation and unemployment in some cases, and that would be one of them. The other thing that can happen with deflation is the debt deflation spiral of doom. I added the of doom, guys, just called the spiral. So a classic example is the harvest cycle. And I know I've explained this in the podcast in the past, but basically we have, as you're planting and then harvesting, we have a change in the total amount of money in the system as people issue currency because people borrow and then they pay back the loans. And when you pay back a loan, then basically what we described for money creation goes in reverse. And when a debt meets the cash, it's like matter and antimatter, disappears. So that bank credit hits the loan, poof, disappears. And what happens in the harvest cycle is that everybody starts to pay back all their loans at harvest, and then it makes cash really scarce, which means it's actually harder to pay back your loans, which means we have deflation, which means that the real interest rate has spiked. Because let's say you borrow at 3%, and then the inflation is 3%. Your actual real interest rate is 0. But what if we have even a 0% loan? You borrowed 0 interest. But we have this debt deflation that happens from the harvest cycle as everybody pays back their loans and money becomes scarce. You borrowed at a time when there was lots of money around because money was being created, because loans are being given to, say, plant your fields. And now you go to pay back, well, your interest rate could be, I don't know, if deflation's at 7%, your real interest rate could be 7%, even though the nominal interest rate is still 0. What's the problem? So historically, the way things like this were dealt with were what is recorded like Pericles in Greece says, let's just make sure that we price things based on these commodities. Let's make these like price floors for stuff and try to make the contracts the same from the beginning to the end of the cycle. And they had some ideas in Greece of how to shore up this whole system so that we don't have a concentration of the collateral in the hands of the creditors through every single cycle, which would happen because you have to call in the loans and then take the fields from the farmers, which is obviously a problem. Now, there was another solution that we actually see in the Old Testament, and that is the Jubilee year. So we have every 7 years, then we have the 50-year Jubilee. So in that case, we say, okay, we have borrowing, we have harvest cycle, we have this stuff, and now the fields are going back to creditors because they, you know what? Just every few years, just give it all back. We just reset the table. And I mean, that's an option too. Now, luckily, we don't have that same kind of scenario where we have this cyclical economy, but we have seen debt deflation pop up. Like in the Great Depression, there was debt deflation as people start to not being able to pay their debts. Stuff is forced to be liquidated, and then it just hits the loan. And now the money supply decreases, makes it harder for other people to find the money to pay their loan. As the real interest rates rise, it makes less things economically viable, and then we get this terrible spiral. Ben Bernanke did a lot of work on debt deflation. Irving Fisher did a lot of work on debt deflation. He like wrote the paper on that. Another example would be 2008. We actually saw a bit of debt deflation despite central bank meddling that happened after that, where the money supply did contract. Japan, if you ever want to see if deflation is actually really a great idea, and we would have it under Bitcoin. Yeah, just look at Japan. I'm going to have to do a whole episode on Japan at some point. They had this big asset bubble. The asset bubble burst. It was a lot of lending around real estate stuff. Things got absolutely wacky in the prices. So banks became insolvent, and then they couldn't really lend out. And then they ended up trying to do a bunch of government borrowing, and then paying into that. And then it distorted the prices in the economy. It reduced real productivity. And then we got this lost decade. And actually, really, they've never recovered. And it's bad. So if you want to see if deflation is bad, I would suggest you go and study what happened in Japan. Now, our economies are not the same. There's a difference between the private and public debt stuff that they have. There's a difference in their savings rate. There's a lot of differences, but it's still a very good study and probably should be a podcast at some point. All right. Some people say, but come on, dude, like TVs have inflation. Inflation good or deflation good? No, that's not what I'm talking about. Because the deflation of TVs does not mean that your wages are going to be lower or you will see unemployment. Deflations in one sector mean that, oh, cool, the TV is cheaper. I think I'll buy some speakers. So it could simply mean that your spending goes to another place in the economy. It doesn't mean that the aggregate spending just falls because the quantity of money is just declining. So it doesn't relate. I'm fine with one sector having deflation. Cool. Typically because of increased productivity, which would be what's happening with TVs. Does not tell us if we want deflation writ large. Doesn't apply. So, are there any quick fixes? Any things that like a family could do in the face of a deflationary environment that could happen from, say, a full reserve gold standard, or could happen from if we just all did Bitcoin and there's a fixed amount of Bitcoin and yet productivity begins to rise, so we don't have enough cash to deal with the rising quantity of goods and services, so their prices fall in Bitcoin terms? Anything a family could do? You could just hoard cash, and that might help. It will make deflation worse for everyone because now you're pulling even more currency out, and this is kind of part of the spiral. But that could help you hurt everybody else. It's an option. Federal Reserve could do some form of quantitative easing to try to increase money creation amongst banks if we hit deflation in general. But I mean, that's not something you can do or your family can do. And QE is pretty tricky to do, and it would require a central bank. And yeah, deflation's bad, guys. Well, what about inflation? Inflation, I didn't like it. You didn't like it. Well, first off, it did help us deal with the debt. And I mean, it hurt, but like, guys, the debt's a lot more manageable after that. You got to realize that this is in balance. Another thing is, let's say that they told us tomorrow that there'd be actually 3% inflation for the next 20 years. What could we do? We could just buy treasuries because, like, a long term treasury represents the expected GDP growth plus the inflation over that period. There you go. So you're protected from inflation, and you also have your money float up based on the expected GDP growth. That's an option. Or you could buy Treasury and inflation protected securities. You could do that right now on the IRS website, I think, or Fed. Yeah, I think the IRS website you can do it. I believe they're tax free up to like 10 grand a year. Anyways, check that out. So that's an option. You could buy tips. You could also just earn wages because remember, with inflation, your wages will start to float up too. You could own any asset because anything you own will float up with inflation roughly. What else could you do? Just throw your money in a savings account. Not all times does that keep up with inflation, but sometimes it does, and sometimes it outpaces it actually. So right now you could probably get a 4.5% yield, but inflation's only cooking along at what, 2.7% or something, depending on when you're listening. So you're making money. Just throwing money in a savings account. Is that hard? The only way that inflation really hits you is if you're keeping all your cash in a mattress over a very long period of time and you go, man, the cash is getting degraded. Okay, pick what you want. Do you want your house, your wages, and everything you own to fall in value? Or do you want the cash that you happen to have in your wallet or under your mattress to fall? Those are your choices. So I prefer inflation because it's very easy to guard against. Heck, buy some gold. There you go. Kind of volatile, but whatever. Own stocks, own bonds, own something that's income producing. So there you go. So bottom line, deflation. That's where your money goes up relative to the prices of everything else, your labor and your assets included, which fall. Inflation. Everything you own, your labor, everything, the price level goes up, but whatever amount of cash that you haven't shielded in the variety of ways I told you, that could go down. So what's the best? The best is if you just got like central bankers together and said, if you could do anything, what would you do? And it would work. They'd probably say, well, I'd love to hit zero. Like we'd have super predictable prices over the long term so that the economy could plan around that. I'd love to be at zero. You go, well, why don't you do zero? They'll say, well, we'd like to. But the fact is, deflation, as we've seen, is worse than inflation. And it can spiral, many problems, cause unemployment. So what we'd prefer is to hit 2% because 2% is a buffer. So we'd love zero, but let's go for 2%. We're pretty confident we can always keep it above zero. Things are good. There you go. Oh, and we didn't get to the zero bound limit. Anyways, we'll leave that one for another episode. Let's hit Bitcoin. Few questions for that. We asked some questions of fiat, fractional reserve, and we kind of explored different types of systems here and a little bit about the central bank. Gave you a very basic overview of some things. Well, maybe a step up from basic. Very basic would be the stuff you find in econ textbooks, which think that banks are only financial intermediaries whereby deposits precede loans. But that's not true. So now you're in the in group of people who know that these two are created at the same time. There you go. There's a few other things that I've pointed out that are kind of not very standard basic textbook stuff. But you could certainly find them. Any economist probably that I've had on the show would explain it the way I've explained it. All right, so what's Bitcoin worth? Well, there's a few ways that we could answer that question. One is we could look at the sum of all future cash flows discounted to the present based on the risk-free rate of return. That's how we would value, say, a stock or a bond or an income-producing asset like that. Okay. Are its cash flows positive? No. If anything, they're negative because, well, it just costs money to run the system. It's not like Bitcoin. Your Bitcoin is running around creating pharmaceuticals to heal people or pumping oil out of the ground. Your Bitcoin is not hard at work running a restaurant and feeding people. It's not doing anything. So your Bitcoin's not creating a value stream that we can estimate, project into the future, and discount to the present. Instead, there's a series of expenses to run the system. So if we use this method of valuing Bitcoin, Bitcoin is worth less than zero. Okay, but what about gold? Gold's not running around and doing these things, is it? Well, it kind of is. It's running around being dental implants, being input for high-tech electronics. It's in jewelry. It's doing things, right? Because it has alternative uses. Gold can be a variety of things in addition to simply the gold that you're holding as a form of currency or something. So what else does Bitcoin do? Does it get value from its use? Do people hang Bitcoins around their neck for style points? No. Nor do they use them as dental implants, nor do they have any other uses for a Bitcoin. A Bitcoin can only be a Bitcoin, and its value is based not from cash flows, not from alternative uses, but from only one thing: the expectation that tomorrow somebody will pay more for it than today. And I use this phrase for a very good reason. Phrase. It's a Ponzi scheme. It is. That's kind of the definition, folks. I think it's just kind of a bubble. I mean, come on. I don't see how that's very sustainable to just always expect somebody else to pay more, and that's what the value is based on. Somebody has to come and buy it later without any cash flows, without any other uses than just the fact that you get to buy it. Not a fan. Now, also, it doesn't have the backing that, say, the US dollar has. What does the US dollar have? Well, it has legal tender laws. You have to accept it throughout the economy. That means there's a lot of demand for it. And no, it will never have an unlimited supply, though the supply grows. But it certainly will have value because, well, legal tender laws mean that there is demand and there is a fixed supply at any given time. It's not an unlimited supply of dollars today. And also, courts make adjudications in US dollars. Yeah, you can enforce a claim in yen in the US, but when it's actually settled and paid out, must be paid out in US dollars. And then we talked earlier about how taxes must be collected in US dollars. So that creates a static amount of demand. So if there's, say, $20 trillion in dollars or whatever, depending on M1, M2, M3, if they even track that, making up a number, and there's a demand for it, well, then there will be a price of your dollar, rest assured. And of course, we discussed how it's backed when Bitcoin is not. So this whole charge that, well, Bitcoin has real value, but fiat currency is just unbacked. No, claim in your bank. That's valuable because they have claim on loans and bank capital. And those loans have claim on assets and income streams. Bitcoin? Nope. Nothing. All right. Is Bitcoin good at being money? Like, money does stuff. We kind of started this whole episode talking about how gold reached prominence because it was easy to divide, it was easy to use, people accepted it, all this stuff. Is Bitcoin really digital gold in this sense? I would say no. How many transactions a second could you make with gold? I don't know. Hand people gold. You could do that a bunch of times. Lots of people could do that. Really easy. How much does it cost to hand somebody a gold coin? Not much. How much does it cost to hand somebody a dollar bill? Not much. It's no big deal. How much does it cost to swipe your debit card and have it pay something? Nothing. I don't know. You might get cash back. I mean, there's charges to the merchants, but that's the thing. Anyways, no big deal. Things can happen fast and things can happen cheaply. However, with Bitcoin, you can only do like 5 to 6 transactions per second through the Bitcoin network. So you might think that you're buying things in Bitcoin. You're probably not. You're probably buying them with some type of ledger in a wallet. And they'll do a batch transaction later sometimes to settle up with other wallets. And these transactions currently are maybe $2 to $2.50 each. And they've spiked when demand rises. Like if we all started using it, demand would spike. And who knows what the costs would be. I've seen it as high as $30. So do you want to use it as money? Hi, I'll take one donut. That will be $1.19, thank you. Oh, never mind. The Bitcoin network is very much jammed up right now. So if you'd like to wait 6 hours so everything gets verified, also we're going to add $40 to your transaction. I don't think people want that as money, guys. And also, let's say that there was fraud. Let's say somebody scammed you. Your JP Morgans, your Wells Fargos can commonly undo that transaction. They can reach back and tell the other bank, dude, you put this over here. That was a scam. Take that out of his account. Give it to our dude again because that wasn't right. Oh, okay, cool. That's kind of an advantage. Bitcoin, goodbye. And some people say, well, it's really anonymous. Not so much, because you always have like your handle or account or whatever tracked. So once we figure out that like this is probably you, then you can track who's buying what. But you might say, well, money does more than just, do the things that money do. It's also a store of value. It's a store of value. Digital gold. And gold is a store of value. Well, here's the issue. We had a test of how Bitcoin would perform when we have a big crash. And the whole COVID crash was an excellent example. And guess what? There was like a 98% market correlation with Bitcoin, where stocks and bonds and everything started to tank. And guess what also tanked? Bitcoin. So I don't think it did that well. Also, if you want it to be a store of value, I think you'd prefer it not to be so volatile, but it is volatile. And next, what value are we storing? Like, we can make an argument that gold is a store of value because it has a value. Or we could even argue that your dollars are a store of value because your dollars are ultimately backed by these loans and collateral and assets and income stream. That has value. Or you could just say my store of value is in a savings account or is in treasury bonds. Cool, that can make sense. There's a stream of cash flow coming from some of these things. But what value is it storing, the Bitcoin? I don't know. Nothing. And then we have, it might store value for a little bit, but what happens with competition? I mean, what if some new kid comes along the block and says, hey guys, I understand the critique that there's no actual positive cash flows. So there's no real money outside of simply the next person purchasing it coming into the network. So I figured that we just do kind of like a stable coin that bears interest. And the interest is based on the return from the total stock market fund. So you basically invest in a little bit of all the equities in the entire world. Maybe throw some debt in there. I don't know. But now you're having a real yield. And now you can just trade this as a coin. I don't know. People might like that better. And then what would a transition to Bitcoin even look like? Because I don't think that many people actually want to work for a year, 2 years, 3 years just to buy one Bitcoin, give up all those wages in order to own a Bitcoin. What did the current owner of a Bitcoin possibly do that he should give you this thing which has no worth and you should supply years of labor in order to purchase it? I don't see where the justice is there. Like, what's going on? So I don't think that we want to transfer to a system whereby we'll massively enrich a bunch of people who have not actually done anything productive for society in simply having bought Bitcoin. Why should they receive an enormous windfall of our hardworking gains? Why? I don't get it. So, yeah. Let's hit a few objections that the Bitcoins guys might say. One, it's a limited supply, so it has value. A lot of things are limited supplies. I could do 10 beautiful finger paintings and promise, upon my honor, not to make an 11th. Doesn't mean they're worth 100,000 each. Even if Hunter Biden made those, wouldn't be worth that. Well, maybe, not anymore. The next one is, what's amazing technology? You simply don't understand blockchain. Blockchain is this wonderful distributed ledger system whereby we can have these peer-to-peer transactions and mining, and it's decentralized. It's the future. It's amazing. We can use this distributed stuff to unlock all these algorithmy, all that stuff. You've heard it. I'm just going to nod along and go, yeah, it's pretty neat. I actually like blockchain. I could see it as useful for a variety of things. For instance, I think if you're, say, in a country where you don't really trust your government, or you're in a place where records could be easily lost, I think you should put things like the deed to your house or your car or important contracts on the blockchain and then have a distributed ledger so that you're not just hoping that your one corrupt government will keep good records of things which are incredibly critically important to you. I like blockchain and I think it could be useful. And some people have compared the the cost to transfer money in the Bitcoin network to, say, the Swift network, which can be pretty expensive too. And if blockchain could be cheaper, then maybe mainline financial institutions could use some of the blockchain technology in order to transfer stuff, in order to track transactions. And if that's going to work, cool. I'm all about it. I think it's a good technological achievement. I think it's pretty neat. I'm a fan, right? Count me in. But what I don't think that means is that the Bitcoin is then worth a huge amount. Let me just give you a counter argument. What if I waxed eloquent about how incredible cell phone technology is? And it's really incredible how it sends all these signals. Sometimes it's encrypted. It goes through these cell towers. It goes to these mainframes and data centers. It's an absolute wonder, and it's making our world a much better place. Cool. If somebody said, so the actual thing that's being traded in this network, kind of like the token here, is the cell phone minute. So therefore, I'm going to buy cell phone minutes, and we're going to see them go to the moon. You'd say, well, no. I'm saying that the network and the technology and all of this is very valuable and can be very useful, but like a cell phone minute, no, I'm not going to pay $100,000 for that. Or you might say, right, but what's being transferred is the actual voice data, so we're going to pay $100,000 for the voice data. No, it's not like that. That's a non sequitur. So that's how I see it when people argue that the Bitcoin network is really wonderful technology. I'll just go, yeah, sure. It does not follow that a Bitcoin should be worth $100,000 though. The last argument. The last argument's the big one. Threw me back on my heels, I must admit. And that is, but Jake, number go up. And I know that's a bit of a strong man, but apparently there's a huge crypto conference that said our core technology is number go up technology, which I think is funny and a bit of a troll. But let's address number go up. Maybe less of a strong man. Listen, podcaster dude, that's nice. You gave us your little banking spiel, some type of fractional reserve fanboy or whatever you are. Nice. But yeah, I don't see a Lamborghini parked in your driveway. I have one. I've made a lot in Bitcoin. A lot of people I know have traded Bitcoin, made a lot of money. And maybe you're feeling left out. Oh, you didn't realize how transformative this is. And you didn't realize it did go to the moon. And you were right. Or you were wrong. And we were right. And you should have invested. And we've made a lot of money. So proof's in the pudding. We're rich. You're not. Eat it. Well, I get that. Sure. Maybe I should have known human psychology a little bit better and made my bet. But that's all it would have been, a bet. Because this is a zero-sum game. There is no money coming from customers. There is no income that's coming from anybody other than simply buying and selling these. So, in order for some people to make money on this, other people are giving up money. It's a zero-sum game, and I'm not interested in betting. I'm not a gambler. I'm an investor, so I prefer to actually purchase things which create value for others, which create value for me, which drive economic growth, and which are real investments in real things. And also, there's one big counterpunch I can give to number go up. Number go down. Because in history, we saw the dot-com bubble. Bubble gets blown up, number go up. Lots of people came out really well from that. It doesn't mean they were acting prudently or wisely or everybody should have followed their lead. If that happened, it would have been more disastrous. But then number went down. Or in the famous 1600s example of the tulips, where everybody's buying all these tulips, the tulip mania. There are lots of people who said, listen, you just don't understand the tulip. The tulip is a new biological technology, which means that we can make an incredible fortune buying and selling these tulips. You couldn't possibly understand. But the fact is, I have flagons worth of wine and many stone worth of cheese, and you don't. So I'm right and you're wrong. People may have said that. People may have been driving very fancy carriages as a result. But it doesn't mean that that wasn't a bubble. It doesn't mean that it didn't eventually burst. And I would warn people who are, quote unquote, investing in Bitcoin to be very cautious here. Let me conclude this episode with what I think could bring this whole thing down. And that's AI. I think there's a very strong probability that in the next year or two, we're going to see a lot of tech jobs and just a lot of white collar jobs in general begin to dry up. Now, there will be episodes on AI, and I'll give you my whole thought about work and the economy and AI and things, but I think we could have a bit of a shock. We saw that there is a labor shock as we brought more laborers in the form of women entering the workforce. This is going to be a lot quicker, so it could drive down wages, at least temporarily, for some, and it could also cause unemployment for others. And the types of people who will be unemployed, I think, is going to overlap very significantly with Bitcoin owners, which means if you're unemployed and you're used to making $250,000 a year and you have to pay for your fancy apartment or your house and your car, you might have to liquidate. You might be forced to liquidate some of your Bitcoin. And then we'll get news reports that go like this. Today, we see that many tech workers who used to be Bitcoin buyers are now selling. The Bitcoin mania may have come to an end as unemployment peaks in the tech sector, and we've seen new job openings decline to their lowest level in recorded history. At this point, many are wondering, will Bitcoin ever recover? That could be a news report from the future. We're going to have to see. And when they're forced to sell, more people will sell. And it will be essentially a run on Bitcoin and could bring it to its knees. I don't know. Could happen. The fact is, zero-sum game, some people are going to lose, some people are going to be gaining, and it's not going to be an even distribution. And you're going to hear only from the people who really, really benefited. So you're not going to get a balanced picture of whether or not you should invest in Bitcoin. So, is it a better money? No. Is deflation better than inflation? No. Is fiat currency backed by nothing? Yeah, it's not that complicated. Is fiat currency basically the same as counterfeiting and fraud? No. Fractional reserve stuff is not warehousing. It's not the same activity whatsoever. Yeah. Should we say that Bitcoin is, to borrow a phrase from one, the most moral money? No, 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 no. I would say it's an entirely imprudent money, and we shouldn't be supporting it. And the US dollar is much better than you might think. And I have my critiques. And if I had my druthers, I'd have a different system. But there's the system that we have. I hope you guys understand it at least a little bit better. If you have any questions, you can always email me at thegordianaut101@gmail.com. Guys, thanks for listening. If you know a big Bitcoin maniac in your life and they need a bit more understanding of stuff and you think this episode might help them, share it with them. All right. Until next time, guys.